This Dow Jones industrial giant has been a frustrating stock for investors in 2024. The earnings released this week had some positives, but despite that, still traded down 4% after the release. The stock is flat year to date, and this is after solid growth throughout the year and no real negative sentiment. This stock, of course, is the ever reliable Visa, ticker V. It is so reliable that Visa can be considered a foundational stock for any long-term investment portfolio. Welcome to The Quality Investor. And teasing out a reason for the post-earnings drop this quarter, the reason seems very similar to last quarter. For certain metrics, there seems to be a clear trend downwards on a sequential basis. Payment volumes, both US and international, and total processed transactions all saw a slowdown in growth. Since Visa's revenue derives from total processed transactions, this slowdown translates into slower revenue growth. I believe this is what is driving the tentative sentiment around Visa. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. There seem to be lingering concerns in the overall market about a potential recession. Combine that with a Fed that has yet to cut rates and weaker consumer spending in 2024, and this may be why Visa remains stubbornly flat. The silver lining on the earnings call, at least, related to Visa's growth plans. These growth plans include growing into white space internationally. This means capturing more consumers into the Visa ecosystem. They also leverage their global brand to capture new users and merchants. CEO Ryan McInerney highlighted this on the earnings call. On the brand front, with the Olympic Games opening ceremony later this week, it is exciting to see the engagement with the Visa brand and activation across the world in marketing campaigns, cardholder experiences, and Olympic and Paralympic branded Visa issuance, which I am happy to report in Europe is at nearly 6 million cards compared to the 5 million number I quoted just last quarter. We have also added nearly 100,000 new merchant locations in France in advance of the event. Our brand also plays an important role in winning co-brand partnerships in India. Growing credit issuance and reaching affluent and cross-border consumers remain areas of focus. We are excited about the launch of a co-brand card with Adani One and ICICI Bank as India's first co-branded credit card with rich airport-linked benefits for their target base of 400 million customers through the Adani One platform. In regard to growing new customers internationally, the CEO highlighted this. And in Vietnam, a country with approximately 50 million wallet users, the three leading digital wallets Momo, VNPay, and ZaloPay are now enabling their users to utilize Visa cards as a funding source for transactions at over 500,000 QR acceptance points managed by these wallets. Visa is a toll collector. Every time a user swipes their card or engages in some sort of online transaction, Visa collects a fee. The more users they have in their ecosystem, the better their revenue will become. This, among other growth initiatives for Visa, should drive future growth for the company and get the company back on track to justify that 30+ PE. So let's briefly discuss these earnings and discuss what an appropriate buy price is for the credit card giant. For a quick overview of the actual earnings for the quarter, we can see here the fiscal third quarter 2024 results. They had $8.9 billion in net revenue, which was a 10% year-over-year change. Their GAAP net income was at $4.9 billion, which was a 17% change. And their earnings per share was at $2.40, or a 20% increase. So yet again, Visa had a very solid quarter of growth, but the market is just not impressed. What the market wants to see is growth in these key business drivers, payments volume and processed transactions. Now, again, they had solid growth here, 7% year over year for payments volume. They had solid growth here, 7% for payments volume and even 10% in processed transactions. But what's hurting Visa is this growth is actually slowing down a bit. If we look at this chart very closely, we can see the payment volume growth in the US peaked at about 6% in May. Total transactions processed, and remember, they collect a fee on every transaction they process, really didn't creep up above 10% at all. Now compare that to last quarter. Last quarter, the growth is clearly higher. Flipping back between the two, you can certainly see that big pop from last quarter. So that's what I mean by the transaction volume, that payment volume. It's slowing down sequentially. The market sees that slowing growth as a sign of potential trouble, and I think that's why the market had them drop 4% after their earnings. Of course, any explanation offered is going to be speculation, and my speculation is that there's just lingering concerns about a recession. One thing markets do like to see is when they improve their guidance. Their full year 2024 guidance for the operating expense growth is now high single digit to low double digit. Compare that to last quarter where their full year 2024 operating expense growth was at low double digit. Now with that high single digit, what they're saying is they actually expect lower operating expenses for the entire full year of 2024. And despite that improved outlook, the improved guidance, the market still punished Visa with a 4% drop. Looking at the cash flow for the quarter, we can see that their net income is substantially higher year to date than it was last year, 14.5% higher. However, their operating cash is actually a bit lower at $13.2 billion this year so far, compared to $13.8 billion last year to date. That is really resulting from them increasing their working capital balance. If you go through and compare line by line here in the operating cash reconciliation, we can see really the big thing that stands out is they paid down much of their accrued and other liabilities, which simply means they increased their working capital. So not a big deal there, but combine that with about 200 million more year to date in purchases of property, equipment, and technology. And we do have slightly lower free cash than we did year to date last year. Free cash flow year to date is at 12.3 billion compared to last year to date at about 13 billion. However, one thing that they are taking advantage of is that flat year to date share price. We can see that they have really bumped up the amount of share repurchases they've done compared to last year, 10.8 billion so far year to date, compared with 8.3 billion year to date last year. So Visa is certainly rewarding its shareholders despite maybe not having quite a good year free cash flow wise as we're accustomed to. In fact, when it's all said and done, it looks like that net decrease we've had this year in 2.7 billion in cash is pretty much the difference between the repurchases year to date this year versus year to date last year. One of the things I talk about a lot on the Quality Investor is the importance of finding compounders, and specifically free cash flow compounders. Well, I just want to quickly demonstrate what that means visually. To me, Visa is a very good representation of a compounding king. You see very consistent growth in their revenue, gross profit, and operating income, very consistent growth in earnings per share, and very consistent upward trend in cash flow. Other things that compounders do to reward shareholders as well is they buy back shares consistently. What that does is it raises the free cash flow per share available to investors. And what we can see here in the shares outstanding is a consistent decline in the total shares of outstanding, meaning consistently repurchasing shares with their excess cash. In fact, Visa generates so much excess cash because it really doesn't have a lot of capital expenditure. They're a very capital light business, another favorite of ours here on the Quality Investor. And they pretty much reward shareholders through their increasing dividend and share repurchases. So after updating the quarterly numbers for their June 24 quarter, I like to see how I'm tracking along with what my year one estimates were at the beginning of the year. And we can see on a revenue basis, they're slightly behind my estimate at about 0.5%, as well as slightly behind the operating profit at about 0.33%. They are, however, ahead in their net income by 2%, and pretty much flat to slightly ahead on earnings per share. And we can see this is what I mean by a disappointing year in free cash flow. Right now, they're tracking to about just under 19 billion in free cash flow. I projected at 19.6 billion. So they are about a 3.5% miss on their free cash flow. But while they're slightly behind there on free cash flow, on a long-term basis, there's nothing to worry about. I think Visa has such a solid runway of growth going forward that they're only going to compound that free cash flow further. So there was nothing in this quarter that warranted an update of any of my assumptions for Visa. So if you want to see my assumptions I had for Visa, they are linked in the video I did previously for Visa in the description below. They closed out Friday with a share price of $259.46. So for my three cases, bear, base, and bull, the discounted cash flow came out at $210.33 for my bear, $297.33 for my base and $389.89 for my bull case. That projects free cash flow growth at about 8% for my base case and 11.5% for my bull case. Visa is a very strong dividend payer. Their current free cash flow payout is at just over 20%, and they've grown their dividend by 18.5% per year over the last 10 years. I expect that kind of growth to continue. On a bear case, their dividend price is at $272.21, $327.34 on a base case, and $404.82 on a bull case. Base case, I'm only assuming 14% dividend growth, and I'm only assuming 15% dividend growth for the bull case. To me, those are very conservative numbers, so I may be undershooting what their true market value is when it comes to the dividend. And finally, I have an exit multiple of $244.04. My comps are, of course, MasterCard and American Express. That gives us a valuation buy price with no margin of safety right now at $293.60. That's a forward PE of 30. With a 10% margin of safety, which is my preferred margin of safety for Visa, that's $264.24, or a 27.2 forward PE. That makes them slightly cheaper than their 10-year forward PE average at 27.9. And you can see right now that they have a 27.7 PE, which is a little bit below their 5 and 10-year average. Historically, they're trading at a bit of a discount. It's not a great discount, but it is a slight discount. And if we continue to see current weakness in their share price the rest of the year, they may be consistently trading in the 250 to 260 range, which I think would make them a very attractive buy right now. Very few businesses can replicate these types of margins: 80% gross margin, nearly a 67% operating margin, and over a 54% free cash flow margin. If Visa can simply maintain their current rate of growth and their free cash flow, I think right now is a very attractive entry point for Visa. One more thing to look at is that return on invested capital, which is at 31.4%. Those are Apple-like numbers. And long term, you can expect the return on share price to converge with that return on invested capital. So all in all, like I mentioned at the beginning of the video, Visa is a foundational stock for any portfolio. And with the very attractive fundamentals that Visa possesses and the slight discount that they're currently trading at, I think right now is a good time to get some Visa because this discount will not last for long. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.